Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we're talking the oil market. What are the fundamental drivers behind its price? What are the other market drivers, including geopolitical risks, that contribute to price? And where are prices heading, particularly in light of the key upcoming decision by OPEC+. Returning to the show is our guest Aldo Spanjer, Senior Commodity Strategist at BNP Paribas. I also want to note that on September 19th in Houston, we're holding another HC Commodities Live podcast event, this time hosted by 61 Commodities, Phillips 66 and Bridge Alternatives. We're talking US natural gas trading in a global market. We've got a great panel lined up. The event is in-person only and requires an RSVP. The event's free, but spaces are limited, both in number and also to industry participants. I'll put links in the show notes so you can click there, get more details, and hopefully I'll see you there. Once again, please do leave us a positive review on the platform you're listening on, particularly Apple Podcasts or Spotify, and particularly 5-star and written reviews. It really does help support the show. And as always, I hope you enjoy the episode. Aldo, welcome back to the show.
Thanks for having me again.
So I guess we're sort of picking up part two in the sense that we covered together power and gas with your colleague James, and now we're going to talk about oil and what the outlook for that market is over the next couple of years. Before we get too into the weeds about now and the future, can you do a bit of world building for us, so to speak, on how the crude market works, sort of what are the fundamentals that drive price, and then give us a bit of a review of the last couple of years to bring us up to date?
Yeah, look, so oil is a complicated beast, I suppose. But the way at the highest level, the way the market works is you of course have the usual supply-demand parameters, i.e. the big suppliers. A lot of them sit in the Middle East, which is where the whole OPEC discussion will go. US increased massively, so the US and the Middle East are surely the biggest producers in the world. If we look where demand sits, US itself is a pretty big consumer, particularly of a lot of transport fuels. Growth over the last few years has been, as with most energy sources and most commodities, actually been quite strong in Asia Pacific. And I'm taking a pretty broad definition here: India and anything east. India, China, probably the biggest ones, which also gives you a sense on why China and any slowdown in Chinese growth and/or demand is such a big thing for oil, because they have been one of the biggest growers in the world. The thing I find interesting about oil, and where it's quite a bit different from gas, is in between supply and demand sits refining. In the sense that demand is basically just demand for products. It's gasoline, diesel, jet, that's the transport side of things, could be bitumen, all that kind of stuff. And you have on the other hand, basically the crude itself. You need to make these products, and that's where the refining sector comes into play. So oil, basically, I see it as having three big drivers: not just supply, not just demand, but also how do I actually make the right products in the right location at the right time. And that's the refining side of things. And for instance, if the refining side of things, for lack of a better term, is a bit out of kilter, you're probably not going to make the right products. And to give you an example, maybe that's an interesting way to look at it, is that one of the big things we've seen over the last couple of years, of course, has been sanctions on Russian imports into Europe, right? Europe got around by importing basically quite a bit more out of the US and a few other countries. The issue there is it changes the quality of your crude, because the Russian crude is medium heavy, and that's where the European refineries are made for. They're now getting a much lighter crude out of the US. So on the crude balances it works, because basically you replace one barrel with another. On the product balances it doesn't necessarily, because if you run a lighter crude you make more light products. And we don't always need gasoline, sometimes we need something heavier. So I think this is why oil is quite a bit more complicated, because there's a third big driver in the equation, which is refining. So you need to look at all three of them. The other part for oil, and we're seeing it today or this week, is it's not just fundamentals, it's really a macro market. In that right now I would probably argue macro drivers, macro headlines. And with macro, I mean both economic as well as geopolitical risk. I put them all on the macro. They basically drive the market much more than the fundamentals that are underlying that market. You see the same in gas, but I think you see it to a lesser extent. So that makes it, for me, a market that is a little bit trickier to model, and is probably, particularly these days, also relatively prone to diverge away from where I would think the fundamentals would put us. And that's really that macro overlay that is quite strong in crude markets.
Yeah, and we're going to cover all of these pieces in detail. Just before we kind of kick off with OPEC and what it is and what its contribution is and so forth, if you just take the last 15 years, and I'm speaking very roughly here, in the 2010s you had essentially oil structurally lower than the past 5 years. It was bouncing around the 60s, let's say. And I know this is kind of going to make people cringe, but roughly speaking, it's bouncing around the 60s to the last 5 years, pre-pandemic really, sort of 2019, 2020 to today, it's been bouncing around the 70s and the 80s. What's behind that structural shift up in prices?
No, it's two things, because it's always supply demand. It's the if you look at the time before the war, because I think that's a good line in the sand. A lot of discussions in crude markets would have been on actually whether upstream players are investing enough in keeping supply going, given where demand is. At those days, and again, it's been a while, of course. In those days, you saw the displacement of oil, which could be electricity in passenger vehicles, could maybe be electricity or even other fuels in heavier stuff. It had to get going still. So people were looking at a market where you saw pretty strong demand outlooks, and effectively suppliers that were more constrained in terms of finding maybe new heartlands or exploring for the oil, finding the people to actually explore for it. So in those years, and this is why prices went up, the worry really was about, can we actually find enough oil to sustain the demand outlooks? And if you have that, you're going to be short, basically, and then prices go up. We're also going to get times, for sure, it probably takes a few years, where you're going to see increasing outlooks on demand, where you see, okay, I see substitutions come up in the system. Maybe I see an end to demand growth, all those kind of outlooks. The moment you get that in the system, you probably start seeing another loosening of the market, in that people are less worried about supply adequacy. And I think we're now a little bit in the middle, in that we moved away from a world where supply adequacy was the big thing, because we're basically worried about weak demand these days. And this is why crude has come off a little bit. And in future, you're probably going to see, undoubtedly, I would say, more pressure on the demand side of things, which then lessens the fear about running out of supplies or not being able to explore the right supplies because of other constraints. And that should probably be a bit of a let-off on price. But it's always that perception of supply tightness, I think, that gets you in a relatively high price period.
Yeah, and I want to talk about sort of the actors who make that perception become a reality in terms of price as well. Let's start with OPEC. What is OPEC, for people like me, and what's their relative contribution on the supply side? And can you give us some sense of their journey over the last couple of years and where they sit today?
OPEC is, if I would have to say it really shortly, it's a nice old school cartel, effectively. So it's a combination of the big, mainly Middle Eastern, because that's where a lot of the oil sits, effectively. It's basically a group of a lot of Middle East, and Russia is there now in OPEC Plus, of course, but before then it was mainly Middle East and Africa. They've banded together effectively in saying, okay, we control the majority of supplies in this world. Maybe we should also make sure that at least we provide, they call it market stability, that we don't get those extreme peaks and troughs in oil prices, because in their view it helps no one. It doesn't help suppliers, it doesn't help consumers. So they try to manage the market to an extent. And the way they try to do that generally is that if you run into these kind of periods where maybe you're a little bit more concerned about supply adequacy, they bring on more supply. In the opposite, if demand is weak, clearly where we are these days, they would curtail supply. And the whole point is, let's keep the market relatively flat. If I look at relative contribution, Look, this is generic terms. The real numbers change a bit, but if you look at oil, the global market, it's a little bit above 100 million barrels a day. That's the global oil market, so supply and demand. OPEC is a bit under 30. They're a bit lower now, of course, because they've cut quite a bit. But OPEC sits, let's say, in the high 20s in terms of supplies, which is about 25 to 30% of the market. So they are material. The other point for OPEC is, and that's an important one, is they're cheap. In that the world has changed a bit when the US came on, effectively, because they're a fairly big supplier now, of course. The upside for OPEC still is their supply is relatively cheap to market. US supplies are relatively expensive if you just look at the break-even cost for these kind of things, which means that OPEC will probably always sit at the left-hand side of your cost curve, always find a market, and that allows them as well to try to manage the market to the extent that they can. And I have a suspicion that one of the subjects in this call is going to be as well, to what extent can they still do it? Because as you get more and more supplies out of non-OPEC countries, because I think that's one of the trends we're seeing, of course your market power decreases. And I think that's not quite a crossroads, but that's a bit of a difficult situation we're in these days.
Yeah, well, let's tackle that. Can they still do it? How cohesive is it as a bloc today? And as you say, really the US coming on has dramatically sort of changed the geopolitical front as well when it comes to oil and the necessary relationships required and so forth. We'll tackle that in a second. But yeah, is OPEC as powerful as it once was? And how have they adapted to, it's now OPEC Plus. They now seem to be meeting more frequently post-COVID, given now it doesn't have to be in person. There is adaptations going on to sort of maintain that control.
The second question is probably the easiest one to answer in it. Are they still as powerful as they were? I mean, you're not. If another big supplier comes on, your relative share goes down. So because the US is basically, if you look at US supply production, it's around 20, 21. So it's massive. It's really big. It's not quite as big as OPEC, but if you get that much of a new supply source over the last decade, basically, into the market, your relative share is going to decrease because demand doesn't increase by that much. So they've lost a bit of influence. However, if you look at, and this is a difficult discussion because you're always going to talk about counterfactuals, i.e. what would have happened without OPEC intervention, I suppose. If you look at what we've seen over the last 2 years, basically, you've seen really significant cuts in OPEC production. They've basically taken out almost 6 million barrels in terms of voluntary cuts, baseline cuts, and all the different cuts they've done ever since the end of 22. You can look at this in two ways, I think, positive and a negative way. You can look at it in a negative way and say, they've done all these cuts and we're still barely hitting 80. Right? That's the negative view because clearly they're playing for a higher price. So you could say they're not really that influential. I'm probably more in the other camp in saying that without that OPEC intervention, it would have been much more dire. In that they probably kept prices, they kept prices from slipping into the 70s. So it's a bit of a counterfactual discussion, which makes life difficult. But on balance, I still do think they have enough influence to move the markets. We've seen it. We have also seen markets basically being relatively conservative in believing OPEC on their word. And with that I mean the moment the announcement comes out of a cut, the market doesn't immediately respond. Actually, if you go back to end of last year, when we had the last cut, the market sold off. Which, if you think about it, is odd. You shouldn't sell off when basically a cartel says they're curtailing supply. You should probably be bullish. That basically is the market saying we don't believe it till we see it. In terms of cohesion, look, it's not perfect, but it's never been perfect. Iraq is producing too much. Russia has been producing too much. UAE has been quite difficult as well. But on balance, I think it's actually been better than a lot of people would have expected like a year and a half ago. It's always tricky because there's so many different incentives and different drivers. It's not a cohesive body. But I would say on balance, my scorecard for OPEC would not be probably 6, 7 out of 10. It's a very difficult position they're in. It's an even more difficult position to get out of, and we can talk about that later, because I don't quite see the exit. But I think it would have been materially worse if they wouldn't have done anything. So in that sense, I'll give them the benefit of the doubt for now.
Just bringing us up to date, what are the June supply agreement? What is the outlook, and how is their policy going to impact the next 2 years and the balance of this?
Yeah, okay. So then I need to give you a few numbers. So effectively, as I said, so OPEC has cut almost 6 million barrels. So they did that in 3 stages. They did 2 million barrels in October. They did 1.7, 1.66 in April 23. October was October 22, by the way. And they did the 2.2 last one in November 23. So that gets you to almost 6, 5.66. Oh, sorry, 5.86, my bad. What they did in June, so the June agreement, they basically said the first 2 cuts, so the 2 and the 1.66, they said we're not touching them. We're basically rolling these over to the end of 25. So that means we stick with the policy. Fine. Of the last 2.2, so the November 23 cut, which was voluntary, they basically said, okay, we want to give you guys a pathway onto unwinding these cuts because we can't do this forever, which is also fair enough. They basically said from October 24 onwards, so basically start of Q4, till the next 4 quarters, so basically till October 1, 2025, we have an intention to unwind those cuts, so unwind the 2.2, so 2.2 comes into the market. However, subject to market conditions. And that's now the problem we have, of course, with OPEC, in that, as I said, the market right now is fairly bearish. So we're lucky if we're going to hit 80 over right now. And so the problem we're having right now in the market is, okay, we have an announcement of intention. Okay, we're going to bring these volumes back. We know that if the market doesn't strengthen from here, it's just going to go down if you bring on more supplies in October. And my problem I have with that is, and that's our outlook here as well, I don't understand why OPEC would do that. Why they would basically bring the market down much closer to 70, I would say, by bringing these supplies back into the market. Because I don't see the upside, right? You would basically reduce the price you get, fine, because you bring more supplies on, but the price will not be low enough to really gain market share. Because to gain market share, you need to get these other supplies out of the market. And you don't do that at 70, you do that at 45 or 40, something like that. So I'm wondering if we're going to see much of a supply increase on October 1. Simple reason, I don't think the market is strong enough for it. And the problem OPEC has is that Q3, I still think Q3 prices come up, but I don't think they're going to go to last year's level. So I think there's a bit of weakness there. Seasonally, Q3 is a strong time for oil, for crude. So if you don't get there in Q3, you're not going to get there in Q4. And you're also not going to get there in Q1 or Q2. So for me, I think the odds of a rollover are becoming bigger and bigger as we keep sitting in this bearish market, where I think a bearish sentiment trumps or outweighs relatively decent fundamentals, I would say, actually on the light end. But we'll talk about that later, I suppose. So I'm getting a bit worried. I think OPEC has an extremely difficult decision to make because they need to make it early September. Right? The supply decision or the supply commitment is October 1. Which means you need to do it in your nominations, which you do early September. We're not far from early September. So if we don't see the upside in the next 2 to 3 weeks, I think it's a very difficult decision for OPEC to bring back significant volumes into the market because you'd crash price.
So then they said, obviously, subject to market conditions. Have those market conditions changed since they made that announcement sufficient, you think, to put a big question mark over that? And obviously, one piece that's very much in the news at the moment is Chinese demand. Can you... How has the market conditions changed since OPEC made that announcement?
Yeah, so they haven't, and that's the problem. So the announcement was in June. So normally if you're June 2. So if you're in June, most forecasters would say June is Q2. It tends to be a relatively weak period because there's a lot of refineries are under maintenance in Europe. And if refineries are under maintenance, they don't need crude because they're not running. So demand tends to be quite low in Q2. So that's weak. Normally people would assume that Q3, so the third quarter, tends to come up because if you look at global runs, so this is where the refinery part of the equation is really quite important. Global runs for refineries are usually max as high as they get around August. Basically there's no maintenance. And then you start to move into the new maintenance cycle which peaks in October. You start to get into there in September. So between September and October, you start to lose capacity again. So people in June would look at August and saying, oh, August is probably going to be quite a bit stronger. Maybe we see the demand upside for OPEC, and that probably needs to be 85 plus, maybe even 90. That's probably the kind of prices people always use for Saudi's break-even prices, fiscal break-even. In June, you could probably have made a case, fine, maybe you're going to get there. Now this case is basically almost gone because A, we're almost there, and B, we haven't seen much. So the lack of change is the problem here. And the weakness we had in Q2 is basically extended. And you're right to bring up China because it's the demand thing here. So Chinese demand in July, we just got the July data. I mean, it's really quite bad. I mean, July runs reduced by more than 900 KBD. So demand is atrocious in China. It's really not good for crude. And that is creating basically the market where we are today. People just don't see the upside to demand. And it's really China driven. Again, I'm a little bit less worried about that than I think most people are, in that if I look at it from a seasonal perspective, July is as weak as it's going to get for oil. In that if I look into August, September, October, so the next 3 months basically, you will see, I think you're going to see a little bit more demand in China from, for instance, in August, the fishing ban ends, which is good for diesel. We're going to see 2 big holidays, Mid-Autumn and Golden Week, which is good for transport demand. That should help particularly gasoline and jet demand. And then through Q4, let's see, there's a big refinery that might switch on or start to do trial runs, Yulong, in Q4. Maybe if they do it well, that could also be an upside. That means for me, I see a bit of upside over the next couple of months from China on a month-on-month basis. Year on year, it's not going to be as good, which means the peak bearishness is probably gone for oil. But I think the market is now in a wait-and-see mode. You need to see this. So we need to see runs in China come up in August, maybe September. Now August is already done, so probably September, before you see this bearish sentiment mitigate. And that is the problem for OPEC, because that maybe gives you September for a bit of upside. I mean, I'm quite okay with that because it's basically my outlook. But that's 1 month, right? And then in October, you're probably going to see demand taper off again because then refinery maintenance kicks off, depending on how big that's going to be. So this is what makes it very difficult for OPEC. They might have just 1 strong month, and then it probably comes off again. This is basically what you would want to have like 3 months ago. That's what you would normally have had. That you could look at a strong July, a strong August, a strong September. That's good. Then you bring supplies back, and then hopefully you don't lose too much in Q4. I think that equation has become much more complicated now because this China weakness continues for too long.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insights call to a longer-term consulting project at encoinsights.com.
Do we have any understanding on what is driving that weakness in China? Is it just slower performance, economically than expected? How much, and I guess this is probably taking the longer view, they have obviously had a rapid increase in their fleet of EVs. China is in many ways leading the energy transition, the electrification of transportation in particular. What is behind it today? But actually, does that look more sustainable now as a weaker and weaker demand? Given the transition they're going through?
Yeah. No, so the short answer, I'll give you a proper one as well. The short answer here is it's all of the above, in that you probably even want to go back to last winter. So last winter, of course, with the whole El Nino cycle, was really quite warm everywhere. So also in China. And that's bad for diesel because that means less heating demand. So it started already with basically a warm winter hitting diesel demand quite hard. And if you look at the products, Again, if you look at the big three products, diesel, gasoline, jet, diesel is by far the weakest, by far. And that's partly this. It started at a very low level, and that's, I guess, heating demand. The other one is it's amplified, still looking at diesel here, amplified by industrials and manufacturing demand being quite low. And that is where diesel is really exposed. So diesel is hit on all fronts. Basically, weak manufacturing and weak industrial demand coming out of a warm winter. And actually, in the heavy trucking sector, we've seen a fair bit of LNG penetration. So it's not so much electricity in the big trucks. It's actually LNG, which again, it's not massive quite yet. But I've seen numbers giving me an estimate of 90 kbd of potential demand increase lost because people are buying more LNG trucks because it makes more sense. So they're hit on every front. So diesel really weak. If you look at gasoline, that's where your electrification point comes in. You're right. So China is, and we know that, is one of the leaders in terms of particularly passenger cars electrification. So that's really growth foregone, I would say, for lack of a better term. What we've seen this year, and this is probably, I would say, a one-off, this year gasoline demand growth actually wasn't too bad. And the reason for that is not because EVs disappointed, because they didn't. It's really because car sales were actually quite decent. So you still have new demand that partly needs ICE engines. And that helped, to an extent, sustain a bit of demand for gasoline. What we also saw, and I think, of course, that's increasingly going to be less and less, because I think the EV wave is not going to be stopped in China. The other one-off support for gasoline has been a bit of a modal shift, in that China only came back from zero COVID last year. So people have been starting to travel a little bit more. You've seen a bit of a modal shift from airlines to cars. So basically group travel to private travel, as I think we also saw in this part of the world. That's probably also a one-off. And then jet is relatively strong in that flights have come up quite a bit, particularly domestic. International has still a bit of a ways to go, but kilometers have gone up quite a bit. Jet demand a bit less because the average is more efficient now. I think we're basically flying on average in a more efficient plane than we were before COVID, but still that demand is relatively strong. So I think that gives you a bit of a picture in that it's really diesel lagging the rest. Gasoline, not much upside, I would say, exactly for the reasons you said, but this year is reasonably okay. And jet probably has the most room to grow in terms of the big transport products. The other one is chem feed. Basically, there's also a lot of crude you want to use in your chemicals plants, right? Because a lot of these chemicals products are simply made from crude, and that is probably a pretty decent growth market.
Yeah,
so the growth sits in the last two.
Coming online right there.
Exactly.
Yeah,
that's sometimes it's not always mentioned, but it's big, and it's probably it's a big demand driver in global oil actually, but also definitely in Chinese oil.
Yeah, just as an aside, what percentage is jet of the consumption barrel, if you'd like? Because obviously we can see a path to electrification within, passenger transport, even trucking now and so forth. But the one hard to abate sector is going to be air travel. Just for the longer range here. I mean, what percentage is it of a barrel, roughly speaking? And can jet alone be reasonably, be a contributor to keeping oil prices up for a much longer period than necessarily forecast?
Yeah, look, jet it's about 7% ish of the global market. So it's a bit above 7 million barrels a day, which is 7% of the market. So it's not small, but it's also not close to where road transport sits, for instance, because that's the big boys. So I do think I would agree with you. It's trickier to decarbonize. The same applies, I would say, for freight, basically ships, which is a similar sort of number. So together they can provide quite a bit of support for demand moving forward. But jet on its own, it is still dwarfed by gasoline and diesel demand. So if you start going with a view that gasoline demand is globally going to be decimated by electrification, this stems the decline, but it's not big enough on its own to fully compensate for it. But the way I would look at it is that I think in gasoline it's easier to displace. In diesel, it's more difficult to displace because you different big batteries basically, and I think you probably want to look more at an alternative fuel coming from a hydrogen molecule, I would say. And then jet and freight are a bit more difficult to do. I agree. You probably look at biofuels before you have the alternative fuels ready, and that I think gives you a bit of runway for oil demand, again, for lack of a better term, towards the back end of the decade.
Yeah. Okay. We've still got a fair bit to get through, but it's fascinating. Just before we talk about geopolitical risk, events, and obviously the world is a much more risky place than in the last decade, generally speaking, I would argue. One of the big things that has arisen in the last 20 years, but seems to be accelerating, and we've covered it numerous times on this podcast, is, of course, you've got an enormous derivatives market attached to oil. That brings a whole sweep of different money in terms of scale, but also drivers and actors there. How, from institutional investors to private investors to hedge funds, you've got a whole new array of participants that you need to model and understand. How significant are they in terms of perhaps accelerating changes, responding to the OPEC statements? I mean, how can you give us some sense of how they drive the market as well, and how you as an economist and a strategist figure out what they're up to?
Yeah, it's tricky in that, again, I think these days are a good example of why this is a difficult one. In that oil has always been a relatively liquid market. So you've always had, at least from the days I started, which not that long ago, you had a lot of traders, a lot of flows, and a lot of liquidity in the market. So that's okay. I think the big change we've seen is particularly on the trend following side, so the CTAs effectively. And what they do is, again, they're trend followers. So these are automated, basically computer algorithms. So they basically see a trend and then pile in on that trend. What we've seen over the last 2 years is that part of the market has really grown fast. And what it does is it amplifies everything, to my mind. It picks up a trend, so the trend is driven by fundamentals, which is good because that's how I look at markets. It then picks up the trend, and to my mind, it amplifies the trend either up or down. So it gives you a higher peak than you would normally have had, and it gives you a deeper trough than you would normally have had, depending on where the initial fundamental driver takes you. So it amplifies the range, but it also pulls it through or extrapolates it for quite a bit longer than you would expect or you would maybe like it to be. So what I think happens is, and this is why we saw all this volatility in oil markets, is that you get higher peaks, deeper troughs, but you also get a trend that gets lengthened quite a bit longer than you like it to. And that's my problem. So from an analysis perspective, I tend to look at the market from a fundamentals perspective because I think that's the tool you have. That's what your models tell you. But now you're looking at the market, but actually you can be divorced from where you think you would want to put the fundamental view for quite a bit longer than in the old days. And for instance, I think right now is a good example. If I look fundamentally at sweet light fundamentals, which is Brent and TI basically, they're not long. I think actually the Atlantic Basin is quite tight. If we look at the EA print today, it was a pretty big draw. And I think we're going to see more draws. Stocks are low. And that's from a fundamentals perspective, that's bullish. Big draws, low stocks, demand probably still through September. That's a bullish market from a fundamentals perspective. But look at what's happening to this market. It's all bearish. And that is partly the sentiment we talked about with OPEC, sure. But that is because also these kind of sentiment changes, they just get extended so long. So the whole point in the market right now is I think most fundamental analysts would probably, I guess, agree with me in saying on the light side in the Atlantic Basin, we're a bit short. But you tell me when this really starts to shift. And this is the problem. This sentiment overlay just lasts longer than it used to in the old days, which makes it difficult. I would always tell anyone, any client, I'll tell you as well, in that in the end fundamentals drive this market, and I'm firmly convinced of that. But the delta becomes bigger and bigger. There are longer periods, maybe even more periods of time where the market doesn't quite respond to where the fundamentals would dictate it to go. I think that's the big change here.
So let me understand the picture before we talk events. I don't know, we've got to talk a time horizon, but let's say by Christmas, fundamentally, if nothing were to change, it all really depends on OPEC's decision for the most part. And it all sounds, whilst you mentioned it being tight, I think it seems to me from the conversation in sort of the broader span, it's bearish overall, and it's probably mostly hinges on OPEC's upcoming decision. Is that fair? And then let's talk about geopolitical risks and what could disrupt that picture.
Yeah, definitely. So if I would have to stack my drivers in order of importance, definitely OPEC. So the OPEC decision is the one that's going to have quite a bit of an impact. Middle East we'll get to. It is also Chinese data. It has to pick up. Again, I think I gave you a narrative where I think it will pick up in September, October, but let's see. If it doesn't, that will really keep that bearish overhang quite strong on the market. That's 2. And I do think, number 3, stocks. Just simply absolute crude stocks in either the US or globally. If you take out the China numbers, because they're basically filling the SPRs. So global stocks without China or just US on its own, they're all well below the 5-year average, and they're actually below 23 levels. If I look at that trajectory, then even with lower draws than last year, which is really quite likely given where demand sits, you can still get to levels that make particularly September quite tricky. So I think those 3. But the last one is that fundamental driver that I do worry about, but that currently is not quite on radar screens yet. And the question is, when does this come on radar screens? I hope early, because that gives you a sort of a relatively moderate response towards a tightening market. If that comes on the radar screen very late, people might panic, and you get these kind of very strong upward drivers. But for me, those are the 3. Number 4, it's a bit of a smaller one, is US production. Because if you look at the updates we've seen from analysts recently over the last couple of weeks, a lot of people are reducing their US supply forecasts for Q3, Q4, basically Q4 where we are now, in that they become a little bit more conservative on how much additional supply the US is going to bring into the market. I fully agree with it. I think the number we had is still the number I think most people are looking for, 300-400 KBD. But a lot of people were at like 600-700 KBD, and they're pricing out or basically reducing the numbers there.
Yeah, and I'd quite like to dig into, we've had guests on the show previously who've spoken about actually that could surprise quite significantly over the coming years how quickly some of that production sort of rolls off as the shale fields turn the production declines much more rapidly than expected. We probably don't have that to go into right now. So those 4 drivers, if they were to remain, or let's say we just stick with those 4 drivers, there's elements of weakness, there's elements of strength, kind of, and I always hate asking this question, but I'll ask anyway. What kind of is your range if all we're looking at really is those 4 drivers?
So let's do OPEC, because I think that's the down range. So the worst OPEC can do, I guess, for price is to not just bring supplies back. So if they bring their supplies back in line with the June agreement, like the 2.2 over a year's time, I think oil quite quickly drops down to about 70-ish, around that number. If they, and again, I said that's a scenario I don't see them doing because I don't understand the incentives there. If they would flood the market like they've done before, again, not the most successful strategy, but still, you never know. If they would bring effectively a multiple of that volume back in quite a short period of time, they would have to bring price back to 45. So my low case for oil is about 45. In that it models a scenario where OPEC says effectively this cutting scenario, this cutting emphasis, it's not working, we can't get the unity done, people want to produce more. You know what, let's go to the other scenario we have, which is not 2.2 in a year, but it's probably 4 to 5 in a quarter, or maybe 2, i.e. you flood the market. And we basically take out a lot of the non-OPEC supply. That requires $40 to $45 a barrel, because that's more or less the break-even price of a lot of these new non-OPEC supplies in the market. So that's my low case. Again, I don't think it's terribly likely, because it's a very painful thing to do for OPEC plus, but you need to think about these kind of scenarios. So that's the low end, I think, of the equation. Look, the high end, I think we need to talk for the Middle East scenarios because that is my high end scenario.
Yeah, it's quite worrying. I mean, we started the show talking about the power of OPEC. Their power to cause massive pain and disruption, particularly for the US producers, is extraordinary and must be in the back of the mind of every investor and board. But yes, you're quite right. We can't talk about the high end without talking about the risks and the potential events, and those are significant. So can you just walk us through what those look like? What potential scenarios could play out, and which of those scenarios seem slightly more likely than others?
No, so look, so if we look at our base case or our reference case, I'm assuming that we more or less stay in the current environment, i.e., I call it almost modeling along. In effect, I don't see it getting much worse, but I also don't see it structurally improving. That's the base case. The high case needs, and again, it's a low probability, high impact scenario in that a lot of stuff needs to go wrong in the Middle East. I.e., I need to see at least 3 steps on the escalatory ladder. But the scenario where I would see oil really ratchet up is if what's happened to the Red Sea happens to Strait of Hormuz. I think that's the one-line summary there. Reason being, Strait of Hormuz is massive. It's 30% of global flows go through there, 25 to 30. And opposite to the Red Sea, you don't have an alternative route. At least with the Red Sea, you can go through around the Cape of Good Hope. It's more expensive, takes longer, you use more fuel, but you still get your products where you want them to. If you constrain part of flows through Hormuz, you have to shut in volumes. So that's the escalatory scenario. Again, a lot of stuff needs to go wrong. I think it's a low probability one. But that is, I cannot see oil below 100 in that scenario. So in that high case, my oil goes to 120. Could also be 130 if you ask me honestly. And I go back after 1 or 2 quarters, I go back to around 100 for the simple reason that I think 120 oil, everybody's talking about inflation again. And if we all talk about inflation, we get the whole macro discussion, I guess, reignited, and that's very bad for oil. So I think that is what balances the market.
Yeah, and OPEC, as you pointed out, have enough held back that they can lower that 120 quite significantly, or at least Saudi can and so forth. And we're also not to mention we're in an election year as well, so oil price in the US it has some political drivers as well. Just so we can all watch out, like essentially, in order for the Straits of Hormuz to be constrained, if indeed shut off, that's essentially a live conflict involving Iran is sort of the scenario where that happens, right?
Look, 2 comments. A, I don't see any of the parties having the incentive to let it go that far, right? So that's why it's a low probability one. The other point you made is important, is that it is not easy for Saudi, Kuwait, and the UAE, which basically hold most of the spare capacity, to actually evacuate their supplies if you constrain Hormuz. So that spare capacity also is quite impeded in terms of the spare capacities there, but bringing that to market is not a done deal if you really constrain Hormuz. So this is actually one of the problems. You can't just bring that spare capacity to market. One of the reasons, and that's maybe the other point, is that why I think, again, low prop, is Iran, of course, would have to instigate that, but their export route is also through Hormuz. So they might also be constraining their own exports into China, which is basically what they're doing right now. So massively impactful, but again, I don't see many incentives quite yet for parties to really pull that lever. So, and it goes for both of my scenarios, right? Both the low and the high. I think the ones we need to think through, because even though they're low probability, things happen in this world. We all thought that Russia-Ukraine was low probability probably until it happened. So I do worry still about these scenarios, even though I keep telling to everybody they are low probability, but we need to keep our eye on them because things can escalate out of control.
Yeah, and some of the mechanisms to control these things escalating out of control are weakening as well, right? So it's challenging times. Well, fascinating, actually, in terms of, again, in the fascinating world and the complexity and actually trying to figure these things out, not just where prices are going, but why they are what they are today. And I think you've done a phenomenal job of laying out some of the gates and the decision points and some of the understanding that leads us to where we are. So thanks very much, Aldo.
Yeah, no worries. Thank you. Thanks for having me.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.